For decades, Sonic built its brand around something that made it completely different from every other fast food chain in America: the drive-in experience. Customers pull into a parking stall, order from their car, and have their food delivered by a car hop. It was unique, it was memorable, and for a long time, it helped Sonic build one of the largest restaurant footprints in the country. But here's what's interesting. The very thing that made Sonic special may also be creating one of the biggest risks for real estate investors today, because consumer behavior has changed. Today's customers want speed, convenience, mobile ordering, and efficient drive-thrus. That's the direction the entire quick service restaurant industry has been moving for years, which is why when I look at this investment, I'm not spending much time asking whether Sonic is a recognizable brand. What I keep coming back to is a different question. If Sonic ever leaves, what happens to the real estate? Welcome back to the Commercial Real Estate Deal Room. I'm Mercedes Shaffer, commercial real estate broker, business broker, and the agent who goes beyond the glossy brochure to show you what you're actually buying. Today we're analyzing a Sonic in Dixon, Tennessee, and whether the combination of the lease, the operator, the location, and the unique real estate justify the asking price and 6.25% cap rate. Let's dive in. Before we get into the pros and cons, let's take a quick look at what you're actually buying. This Sonic is being offered at approximately $2.5 million with a 6.25% cap rate. The property is leased to an experienced Sonic franchisee that operates about 32 locations and provides a personal guarantee on the lease. That's an important detail because when I evaluate a net lease investment, I'm not just looking at the brand. I'm looking at who's actually responsible for paying the rent. An experienced multi-unit operator with a personal guarantee gives me considerably more confidence than a small operator with only 1 or 2 locations and no meaningful financial backing. The store is reportedly generating strong sales with a healthy rent-to-sales ratio, which is certainly encouraging from an underwriting perspective. But the detail that immediately caught my attention wasn't the cap rate or even the operator. It was the lease term. There are approximately 7 years remaining on the lease, which means we're not evaluating a 20-year income stream. We're evaluating a property that's eventually going to face a renewal decision. And that's important because I think the entire investment comes down to one question. Does the combination of the operator, the location, and the underlying real estate make you comfortable with what happens when those 7 years are up? Now let's start by talking about the brand itself. One thing I'll say about Sonic is that it's easy to underestimate. The company has been around for decades, operates more than 3,500 locations across the country, and has built a very loyal customer base. This isn't some new concept that's still trying to prove it belongs, but I think Sonic is one of the more interesting restaurant brands in the country because it's a little difficult to categorize. It's not a hot emerging growth brand like Dutch Brothers. It's not a dominant category leader like Chick-fil-A, and it's not a struggling legacy brand either. Instead, Sonic has managed to remain relevant by evolving its menu and giving customers reasons to visit beyond the traditional meal. One area where I think Sonic deserves a lot of credit is its beverages. Long before customized drinks became popular at places like Dutch Brothers and 7 Brew, Sonic was already building a reputation around slushes, limeades, flavored drinks, and specialty beverage combinations. Those products tend to carry attractive margins and create repeat visits from customers who aren't necessarily coming in for burgers and fries. The company has also done a good job creating demand outside traditional meal periods. Promotions like happy hour and an expanded beverage lineup have helped drive afternoon traffic, while an all-day breakfast menu gives customers another reason to visit throughout the day. That's important because the more occasions a customer has to visit, the stronger the underlying business tends to be. At the same time, I don't think Sonic enjoys the same level of excitement or brand momentum that we're seeing from concepts like Chick-fil-A, Raising Cane's, Cava, Dave's Hot Chicken, or Dutch Brothers. The brand feels mature, it has a loyal customer base, but I don't know that many consumers are actively seeking it out the way they are some of today's faster growing restaurant concepts. And that's really what makes Sonic interesting from an investment perspective. This isn't a story about explosive growth, it's a story about durability. The question isn't whether Sonic becomes the next big thing. The question is whether it can continue generating consistent sales and remain relevant enough to support the lease for years to come. Now let's talk about what I think may be the most important aspect of the entire investment, the real estate itself. One thing that immediately stood out to me is the building size. At roughly 1,225 square feet, some investors might initially view that as a negative. I actually don't. In today's quick service restaurant environment, smaller buildings are often a positive. Operators are increasingly moving away from large dining rooms and focusing instead on efficiency, lower operating costs, and higher throughput. In many ways, that's exactly where the industry is headed. Look at concepts like Dutch Brothers. The building footprint is relatively small, under 1,000 square feet, but that's by design. The goal isn't to maximize square footage, the goal is to maximize sales while minimizing unnecessary space and operating costs. So the issue I see with this property isn't the size of the building, it's the site layout. Sonic was built around a very different customer experience. A significant portion of the property is dedicated to drive-in stalls, covered canopies, menu boards, and parking areas designed for customers to pull in, order from their car, and remain on site while they eat. That's what made the brand unique for decades. The question is whether that same format still creates the same competitive advantage today. Consumers still want convenience, but convenience looks different than it did 20 years ago. Mobile ordering, delivery, dual drive-thrus, curbside pickup, and grab-and-go service have become the norm. When customers can get fast service from Chick-fil-A, Dutch Brothers, Starbucks, McDonald's, and countless other concepts, does the traditional drive-in model still provide the same advantage it once did? I don't think there's an obvious answer. Some investors may view the format as a unique differentiator that's difficult for competitors to replicate. Others may question whether so much of the site is devoted to a customer experience that isn't as relevant as it once was. And that's where the re-tenanting conversation becomes important. If Sonic were ever to leave, I think adapting the site for another user could be more challenging than many of the newer restaurant prototypes we've discussed on this channel. The building itself isn't the issue. In fact, the smaller footprint could be attractive to another operator. The challenge is the specialized site layout surrounding the building. The very things that make this property uniquely suited for Sonic may also make it more difficult and expensive to adapt for a future tenant. And that's something I would want every buyer to think carefully about before making an investment decision. The other thing I keep coming back to is the lease term. There's approximately 7 years remaining on the lease, and while that's certainly not a short lease, it's also not the 15 or 20-year lease terms we've seen on some of the other newer construction deals. Now, if this were a brand new property with 15 or 20 years remaining, I probably wouldn't spend nearly as much time thinking about the real estate. But with only about 7 years left, I think the conversation changes. At some point, every buyer needs to ask themselves a simple question. What happens when those 7 years are up? Will the operator renew? Will Sonic require significant upgrades or renovations? Will this location still fit the company's long-term strategy? And if the answer to any of those questions is no, what are your options as the property owner? That's why I spent so much time discussing the site layout in the previous section. The smaller building itself doesn't concern me. In fact, I think the smaller footprint is actually a positive. It's the specialized layout surrounding the building that I'd be paying close attention to. If Sonic leaves 15 or 20 years from now, that's one conversation. If renewal discussions begin in 7 years, that's a much more immediate consideration. None of this means I think the investment is bad. It simply means I think investors are being compensated for taking on a little more uncertainty. And in many ways, that's exactly what the additional cap rate is paying you for. As part of my due diligence process, I'd also want to better understand the financial strength of the operator and how this location compares to the rest of their portfolio portfolio. Some of that information may only become available after signing a confidentiality agreement or NDA, so it's not something I could publicly discuss in a video like this, but it is something I would review with a client during the due diligence process. Because at the end of the day, we're not evaluating a piece of real estate. We're evaluating the lease, the operator, the business, and how all of those pieces come together to support the income stream. So who is this investment really for, and does the cap rate make sense? I don't view this as a wealth preservation investment, and I don't think it's the type of property most investors buy and then forget about for the next 20 years. To me, this is better suited for an investor who wants a little more yield than they're going to find in a Chick-fil-A, Starbucks, Dutch Brothers, or some of the newer long-term ground lease investments we've analyzed on this channel. The trade-off, of course, is that you're accepting additional risk in exchange for that higher return. I also see this opportunity as well suited to an investor who sees potential beyond the current lease. If Sonic ultimately decides not to renew, there may be an opportunity to re-tenant the property at higher rents, increase the value of the asset, and either hold it for additional cash flow or sell it at a lower cap rate. Of course, that strategy comes with risk, but for some investors, that's where the opportunity lies. And if that day ever comes, it's exactly the type of situation I help clients navigate. But that strategy requires patience, capital, and a willingness to take on uncertainty. This is not the type of investment I would recommend for someone looking for the most passive option available. Personally, I think the biggest challenge with this deal is the valuation. While I can understand the argument for a 6.25% cap rate, given the operator, the reported store performance, and the Nashville area location, I also think investors are taking on meaningful lease rollover risk and meaningful re-tenanting risk. For me, the cap rate feels a little tight considering those factors. If this property were offered at a higher cap rate, I think the risk-reward equation becomes much easier to justify. At 6.25%, I think buyers need to be very comfortable with the operator, very comfortable with the location, and very comfortable with the possibility that 7 years from now, they may need to actively solve a leasing problem. What do you think? Does a 6.25% cap rate adequately compensate investors for the lease rollover risk, the specialized site layout, and the uncertainty surrounding a future renewal? Let me know in the comments below. I'd love to hear how you're evaluating it. Every real estate investment carries risks and trade-offs. The key is understanding that risk before you invest. So if you're evaluating triple net properties, navigating a 1031 exchange, or considering the sale of a property and would like help analyzing your options, I'd be happy to have a conversation. As a commercial real estate broker, I help buyers and sellers evaluate, acquire, and market net lease investments nationwide. And you can find my contact information in the description below. And if you have a property you'd like to discuss or potentially have featured on a future episode on this channel, I'd love to hear from you. I'm Mercedes Shaffer. This is the Commercial Real Estate Deal Room, and I'll see you in the next deal.